Here in front of me, we got Jeremy Buchanan, hailing all the way from Greenville, South Carolina, where he grew up.
That's right.
He lives in West Knoxville now with a wife and 2 children. He went to the University of Alabama, better known as Uneducated College.
I do have all of my teeth.
Yes, you do have all your teeth. That's good. Alabama fan with teeth. Weird. He studied business management and became a loan officer in 2006. So he has over 16 years of experience in the field of giving loans in various different ways. And the only reason that he's allowed to live in Knoxville is because his wife actually went to the University of Tennessee. So it protects him from bodily harm.
That's right.
Awesome. Welcome, Jeremy. How are you?
Good to be here.
Yes, I'm really glad to be here too. And just a random shout out, how I know Jeremy is he actually did one of my loans for a house, and we were having a lot of trouble getting my income to basically be confirmed or like pass through all these regulations. And we gave it to him, and he did it in like 2 days and basically saved us getting the house that we currently live in. So he is really good at what he does. He's really good at helping you as the consumer get the house that you need. So we will definitely give you a link and maybe a phone number at the end of this for anyone who's looking at houses later on. So he's awesome. So there's a shout out for Jeremy. So today though, what we're going to be talking about is if you are a first-time home buyer or you have no idea how to get a loan and all these questions that people have when they're thinking about investing in real estate, we're going to be chatting about what you can be doing now while you're in college, high school to prepare yourself. So when you buy your first home, you don't run into a bunch of problems, have to put it off for a few years, have to have cash sitting around when you really want to invest it in a home or something like that. This is all about helping you be more educated. So at the end of this podcast, we're really hoping that you will be a much more educated first-time home buyer and know what to do and what terms mean so you're not going in there blind. Does that sound about right, Jeremy?
No, that sounds good.
Awesome. Cool. As we always start out, we're all about young people here. Jeremy, we'd love to hear about your origin story, how you became a loan officer, why you became a loan officer. Tell us a little bit about your background.
Yeah, so growing up playing basketball, my high school coach was a mortgage loan officer full-time. Okay. So just kind of hanging out with him after practice, weekends, all the guys would come over, cook out, whatever. I even spent some time with him at the office. And I just thought it was fascinating, kind of the paperwork and, helping people get into homes. And here I am, 16 years later. He has since gotten out of the business, but I'm in it.
There you go.
Or still in it.
Gotcha. So 2006, whenever you got started, why'd you start then? Or I guess after college, or how did you figure out that you wanted to be a loan officer, like during college, or what steps did you take to reach that role?
Yeah, I went to work for his firm.
Okay.
And then some mergers, things changed. Ultimately, I moved here. That's it.
Gotcha. That is actually a really important skill that young people need to learn is using your network from high school, right? So
yeah, the right network. Yes.
Yeah, it sounds like with your basketball coach, you built a great relationship, graduated college, got right into the same field, and he hired you right out of college.
Yes.
Yes. So make sure you get to know your teachers, right? Yeah. Build a relationship there. So that's good. Okay, cool. Well, we'll just jump right in. Tell us a little bit about being a loan officer and what you do for people, and what's the difference between going with a broker like yourself versus a big bank that maybe you've grown up with.
Yeah, so I've worked at a bank, I've worked at a non-bank, and I'm now a broker. I like the broker. In my opinion, it's the best of both worlds. You don't have the middle management that you're going to have in big retail or big bank, and all those costs, salaries, health insurance expenditures, they all get baked into margin, which lead you to the rates or the spread in the rates. So I'm able to offer, as a broker without the management team, I'm able to offer them much better pricing. HMD just released a study that showed that the average person that went to a broker saved $9,000 in cost in comparison to a big bank or retail.
That's just because you've got access to all these different things. You can sort of cut out the middleman, basically.
Hundreds of lenders, they do, all kind of different.
Gotcha. Okay.
Things you probably wouldn't think that were out there, that they are, and we can do them.
Absolutely. So as you're growing up, you're getting older, you're graduating college, you're a young adult, young professional. One of the biggest things is to find the right people to partner and work with for a long period of time. You want to find somebody like Jeremy who's really well knowledge, who can save you money, when you go to him. So that's an important thing right there. So that's one reason to use a broker, which I think is really smart. What do you think is the biggest mistake you see a young person make when they're buying their first house?
Probably maximizing their budget, especially if, let's take someone that maybe recently married, they have intentions of starting a family down the road, but they've maxed out the budget on the house.
Okay.
If you're going to grow the family, you're going to have additional expenditures come up. So you probably shouldn't go to the max when you're going to have other events that are going to need income to support those events.
Okay, can you explain the maximum budget to just layman's terms of what that would look like? Can you give a scenario of what that looks like in real life?
Yeah, so let's say, simple math, let's say someone earns $10,000 a month. From a mortgage qualification perspective, you can go up to 50 and sometimes higher, but let's just say 50% debt income ratio.
Okay.
So your payment could be as high as $5,000 if you have no other debt.
Right.
So let's assume there's no other debt. But if something happens down the road, you have to finance a car, you have a couple children, then you got daycare, you have no disposable income left over after, because because you make 10 to bring home 7. If 5's going toward the mortgage, now 1,000's going toward the car, another 1,000 today, you're out of disposable income. That's the biggest mistake I see.
And you're saying 10 after taxes? Or you're saying 10 and then you have your taxes?
And then taxes, and then you bring home 7.
Yeah.
In that analogy.
Taxes suck.
Yeah.
Okay, so basically, what's your opinion on financing a car? Is that ever good? Why would that ever make any sense?
I think it depends on rate. I do like paying cash, but if you're at 0% or 0.9, I mean, hold on to your cash, and I don't see an issue with that.
Mm-hmm. Just like reinvesting the cash somewhere else would get you a better return than obviously spending it all in the car, is what you're saying.
Yeah.
Gotcha. Okay, cool. So biggest mistake, maximizing your budget, not leaving room for error. What are the couple mistakes that you see people do, when they're trying to get their first home?
In the last few years?
Mm-hmm.
I think the other issue is waiving. You probably don't see this much now, but in the last 2 years, you're writing an offer, you're going over ask price, you're waiving all your contingencies. You have no safety net.
Mm-hmm.
If something happens to the house, and I've seen it, it's happened to my neighbors. If something happens to the house, you have to redo all the duct work or whatever. The insurance is not going to pay for it, and neither will the home warranty. So let's just think at a margin.
Gotcha. What does a home insurance or home warranty normally cover? Again, this is if you've never owned a home before and trying to understand where you're protected, where you're not.
So a home warranty, if you get into the house and let's say the dishwasher breaks or the HVAC goes out, the home warranty would cover to replace that.
Okay.
If you waive your inspection, so no contingencies, the home warranty wants to see the contract and then they don't cover it.
What's the biggest mistake that you see a first-time home buyer, do, and how should they avoid that?
I see a lot of first-time home buyers overextending themselves on the house they're buying.
Mm-hmm.
So maybe they want to start a family, they don't have one yet. If you overextend on the home purchase, then you don't have enough discretionary income left over to do the other things that you also, family, vacation, future automobiles, etc. That's the biggest mistake I see. In the last 2 years specifically, probably inspection waivers.
Mm-hmm. Okay.
I want it. I don't care what it appraises for. I don't care what's wrong with it. Just waive it and let's go.
So an inspection, just in case you don't know what an inspection is and you're listening to this, an inspection is where you have a professional come in and they take a look at your house and they look for any like methane gases, radon gas, all these different gases, all these different like water damage, mold, and they can give you a really good idea if there's any issues with that house, and they'll give you a really good report. And if there's any issues, you can basically negotiate with the seller, right? So you can basically get them to fix it or give you money or make the house cheaper for you. So you really want to do an inspection because it's going to set you up a lot better financially for buying that house. And it may scare you away. If you get an inspection, you might find that there's like been mold in there that's going to cost $10,000 to fix. You're like, man, you know what? I don't really want to do that. But if you'll do it, I'll still buy the house. And then they'll be like, okay, we'll fix it. And then you buy the house and then it's fixed by the time you get there, for example. Because if you think about it, are they really ever going to sell that house if they don't fix it? No. Well, no, right? So then you can negotiate, right? So it's really important to negotiate buying your first home. A lot of this stuff's important about like thinking about your money. So if you're thinking about your money, if you make $10,000 a month, as Jeremy was telling me before here, you're going to have $7,000 left over after taxes. Don't spend $5,000 a month on your mortgage. Buy a house that is below your means. That's nice. That's clean. That doesn't have issues, but you want to invest in something that's going to grow and appreciate over time. So the biggest things to look for is really where's the location at, right? Are you in a really terrible place next to the projects, right? Maybe that housing value is not going to go up a lot. Or are you in like a nicer area where there's developments, there's new parks being put in? Those are the type of things you want to think about, when you're buying that first house. So that way you're going to be creating value over time. Because Jeremy, like, how do you, if you're talking to a first-time home buyer, how do you explain appreciation to them or like the building of wealth in a simple way?
Yeah, and I try to discount the last 2 years because that's unprecedented. But yeah, if you buy a $400,000 house today, typical appreciation is 4, 5, 6% a year over time, over a longer period of time than the last 2 years. The last 2 years, I think sales price year over year, the median sales price in Knoxville's up 31%, and that's just year over year. I know folks whose home prices have doubled, new neighborhoods, etc. If you were the first one in a subdivision in the last 2 years, you probably doubled your equity or doubled in value. That's how the wealth builds. You have an appreciating asset. It's not like an $80,000 Denali that's worth $75,000 when you drive it off.
Mm-hmm. So like, what are the factors that make appreciation happen? Is it just market? Is it loan rates? Is it just, there's a shortage, or how does that kind of work?
I think rates are the carrot, and they have been up until the last few months. But no, just future sales. And I know we saw it in 2008. That was unprecedented. But it is very rare for a home to decrease in value. Mm-hmm. I mean, it would take a global depression. Mm-hmm. And we've seen one, but they're also up since that point.
Mm-hmm. Right.
So they rebound.
So like, why does a global depression change the home value in Knoxville, Tennessee, even if it's nowhere near it?
I didn't see too much depreciation in 08, 09. You saw more of that in the higher home priced areas like California, New York, Arizona. Knoxville's always been kind of sound. Now, some could argue that the prices of the last 24 months, maybe we're getting in that higher, but we're still nowhere close to Nashville. I mean, so I do not foresee values decrease. They're stabilizing. You're not putting a house on the market for 4 and getting 5 cash, all waivers, all inspection waivers. You're doing due diligence in this market. You're getting the homes, So no, I don't think you're going to see depreciation.
Sure. What's the difference between a buyer's market and a seller's market? And why should a home buyer pay attention to that?
In a buyer's market, you are going to be more prone to get a little help with closing costs. That's something the seller could pay. In a seller's market, if you look at the last 2 years since, COVID, we've had a lot of folks move into Knoxville. It's a seller's market. So they can say, they can list it over value. They can not want appraisal contingencies or inspection contingencies, but you're not getting that in this market because it's a buyer's market.
Right. So why does the buyer have the power now?
Well, rates are more than 4% higher. Okay. So activity slows. So when sales start declining and you don't see the madness that we've seen in the last 24 months, the pendulum changes. And so values are still good, but it's more of a buyer's market now than it has been since COVID.
Absolutely. And when you're talking about rates, just for a listener who maybe has never heard of a mortgage rate before, what happens is when those go up or down, it incentivizes people to borrow or not borrow, right? So if you have a higher interest rate, you don't want to borrow as much because you're paying more back over the years. If it's a lower interest rate, you're more likely to buy. And so those rates have gone up to battle inflation, to make inflation lower. Just explaining it to someone who's never heard of it before. How do you describe like mortgage rates and inflation, and how are those related?
So I'll give you one quick stat. Last year you could have financed $800,000, and if you compare that to today, you could borrow about $475 to get the same principal and interest payment. So that's $325,000 in difference. Okay. Buying power that you lost from $299 on a 30-year fix to $699 today or $7. Everybody's going to be different, but the average fixed rate right now is 7.038.
Oh wow. Okay. Gotcha. So the buying power, you said 200, how much thousand?
The difference?
Yeah.
325.
325,000. So
that's
basically, it's basically another house to get. Okay, gotcha. Because the interest rate. Describe refinancing, because one of the things that my wife and I are going to do is refinance when the rates come down. You buy once people drop their price, even though the interest rate is kind of high. That can be scary, but what is refinancing and why is that a good thing?
So I tell folks, you marry your house and you date your rate. So that's a good thing you brought that up. So if rates drop to 5 or 4, whatever, and you're at 7, well, that's 3%. So on $200,000 loan balance, that's if you drop 2%, that's $4,000 a year. 2%, 200,000, it's $4,000.
Right.
So that's so you can save monthly. You can reduce your term and cut out. So maybe you keep the same payment because you're comfortable with the payment, but you go from a 30 to a 20. Now you've cut 10 years off. If your payment is $2,000 a month, that's $240,000 you're saving. That math may be incorrect.
Yeah, sure. But the whole idea though is when you refinance,
you're still reducing your term.
Yeah. So you're basically lowering your overall costs because the rates change, and when you lock in your loan, like if you bought a house at 2%, you can stay there the rest of your life if you'd like. But if you went in at 7, you always come down to a 3 or a 2, and sometimes it's actually better to invest in that because, for example, if there's 8% inflation and you have $100,000, well, your buying power is now 92 cents, for every dollar next year. But if at least you invest it in a house, although your interest rate might be kind of high, at least the house might appreciate, right? And then you can reinvest, or you could refinance, your loan rate to be lower. So that way that money's just not sitting around, for example, if you did have a lot of money lying around. Is that correct?
Correct.
Absolutely. So refinancing is a really cool skill. So Jeremy, what's the difference between a retail, wholesale, bank, and direct mortgage? Describe this for us. I don't even know what those are, and I've bought 2 houses now.
Yeah, so when you go to a bank, you're dealing with that bank, their guidelines. Of course, Fannie Mae, Freddie Mac, HUD, which governs FHA, VA, they make the rules. Okay. They say this is what you can do.
These are government organizations, if you didn't know that.
Well, except for Fannie, Freddie, but they're under government conservatorship.
Right.
So they make the rules, but there's also some buyback. There's a lot of things behind the scenes. So a bank may say, all right, we know that VA will take a 500 credit score, but we don't want to deal with the risk because of penalties, etc. if it were to go into foreclosure. So they may say, well, our minimum credit score is 620 or 640 or 660. But anyway, so you're still dealing with that bank. You don't have another option. It's what the rules that they make. If you go to a what they call a correspondent lender, so you're dealing with that lender, but they may have 3 or 4 investors. With me on the broker side, I've got 200 lenders that I could send the loan to. So whoever's cheaper, better, faster, that's that's who we send the loans to.
Gotcha. Okay, cool.
So you have more options. There's more flexibility. It allows for lower credit scores. You're going to find more ways to yes with a broker than you will bank or correspondent.
Yeah, because they're just trying to give you a mortgage within their own purview, whereas you could...
Particularly with lower credit scores.
Gotcha. Okay. So if you have a lower credit score, a broker can get you a better deal and better 100%. Rates. And okay, gotcha. Okay.
If you're a first-time home buyer, some banks, they have some things they have to do for community reinvestment acts. So they may be able to tailor something different than I could, like on a first-time home buyer, 100%. Mm-hmm. But I'm open about these conversations. So if I'm not your best fit, I'll tell you. Yeah. I'll tell you where to go.
What would your advice be in finding someone who would be a great loan officer, someone you can entrust long term? Same thing maybe for a realtor if it's your first time buying a home.
Yeah, I would say find someone you can trust. I think the likability thing is a little overrated. Mm-hmm. It's like I would rather find someone that's honest with me before I got to the point of whether I liked them or not. Because you can like someone that turns out to be a liar.
Yeah.
I mean,
yeah.
So just find someone that's honest, that communicates, that's answering your questions. If you're lost in space after 3 weeks, there's probably a problem. And don't be afraid to ask questions. Ask all the questions you want. And if they don't answer, go find someone else.
Yeah, absolutely. I would say that figuring out if someone's dishonest or not is like you're asking the question, they don't answer it like pretty quickly, pretty honestly. Yeah. Sometimes they'd be like, hey, I don't think this is a good thing for you. And I think one of the things also too is just look for, are they just trying to get you to say yes, or are they trying to get you a deal, right? If someone's trying to get you a deal, that's somebody who you can trust because they're making less money. So obviously people make money in this business, realtor or loan officer. If you buy a house, if you don't buy a house, they don't make any money. But they're like, hey, get a smaller one. Like, I don't think you ought to go that high, right? That's a good thing because they're just looking out for your interests instead of whatever their own are. So that's a great way to figure that out.
Don't find a yes man or ma'am.
Yes. Oh, like, sure, of course you can do that. And you're giving up almost half your income, every single month to buy a house that you really can't afford, right? So how does someone get pre-approved, and what's prequal and pre-qualifying, and what is all that, and why do you need to do that in order to go look at houses?
So the difference in a pre-qual and a pre-approval, a pre-qual, you're just telling the information. So you're telling me how much you make, how much you have in the bank. You're telling me your credit score based on a very disconnected Credit Karma, score. Those scoring models are different than what they use in mortgage. But anyway, that's a pre-qual. A pre-approval is I'm going to hand you my W-2s, my pay stub, my bank statement, my driver's license, so on, and we're going to have an underwriter look at the loan and approve it in that regard.
Gotcha. Okay. What's the best way to prove your income? And have you ever seen a horror story where someone just couldn't prove their income no matter what? They making all these mistakes, or tell us a little bit about that.
Well, yeah, I mean, you see that sometimes with anyone 1099 or self-employed, because they have the opportunity. So they may tell you, I make $200,000 a year, but then you uncover they have $250,000 in expenses. Well, that's not making $200,000 a year. It's losing $50,000 a year, whether it's literally losing $50,000 or just for tax purposes. But either way, that's how you determine the income. It's taxable income. And I have options for either one. So you don't have to make any money if you have down payment. Mm-hmm. I mean, literally.
Yeah. Okay. Gotcha. What is like a horror story? Like you've worked with someone and they just like as a first time home buyer and it was just a nightmare and you couldn't get this stuff. Like what should a first time home buyer do in order to ensure the success of getting the houses that they're looking at?
One that sticks out is they were emotionally invested going in. Mm-hmm. So before any inspection, they were in love with this thing. So there's water damage galore in the basement. So guess who orders the inspector? The realtor trying to sell the house. So it's his guy. It's her guy. His or her guy. And of course they produce the document that he or she wants to see, which is no issues here. It's normal. And I had to, I just decided for me, I just kind of walked away from that transaction because they were over leveraging and then no repercussions for the water, so I suspect that will ultimately go south. So I walked away. I didn't feel comfortable. It's my NMLS number and I didn't feel like he was making a sound decision. I feel like it was all emotional charge.
Mm-hmm. So, yeah, probably gonna lose a lot on that deal. No fun. Please listen to your advisors. You should listen to your people a lot of times. Especially once you've got a relationship with them. Just listen to what they're saying. That a lot of times they're doing what they're doing. They're successful at it for a reason. So, if you ever get some advice to a first-time home buyer for a real estate strategy, how should they go about developing a real estate portfolio? What's the difference between an investment property and a personal residence?
Yes. So when you buy a personal residence, you're really only agreeing to live there for a year. So some of the most successful real estate investors I know will do that. So they'll buy a house, live in it for a year, save. Now they're not driving $80,000 cars. They're driving Honda Civics. So they save for another down payment. They convert their current home to a rental. Now it's cash flowing. They buy another one. 12 months later, they do it again and again. 10 years later, they've got 9 houses, 4 of which are almost paid off. They're all cash flowing, still driving the Civic, and got a lot of money in the bank. You can certainly do that.
Mm-hmm. So what's the difference though between a personal residence loan versus investment loan?
It's another layer of risk. So investment, obviously you're not going to live there. So if you have 10 mortgages, 1 of which you live in, 9 of which you don't. If financial distress happens, which 9 are you walking away from first? The ones you don't live in. That's why you're going to see higher down payment, higher rates. But obviously there's still a great return on the rental income. And then what you do with that spread, it's up to you. I mean, you could pay down the principal, you can invest it.
Right, yeah. And the idea of real estate investment, if you don't know much about real estate investment, the whole point is that when you're buying these houses, they're hopefully appreciating over time. So you're building up equity. So you're building wealth that way. But also if you rent them out on Airbnb, some properties can make you $80,000 cash flow a year and you pay out the mortgage and you just pocket the rest of it. And you can be, when you have 10 properties, easily profiting $10,000 to $20,000 per property per year, especially if they're in really good places, depending on the size, of course, and making $120,000 to $240,000 a year. And so the idea of that is to really save your time, multiply your time, so that way you can do work, whatever you want, because you have money coming in. You don't have to be a slave to whatever job you end up working, where like, oh my gosh, if I don't do this job, then I can't pay my bills. And what you want to do is do whatever you need to basically get to a point where you're doing what you love, whether that's something that makes you money yet or not. At least you have all that those properties that you could sell or that you're making money from every single month. So it's just covering your assets. That's a game.
And it takes time. It doesn't happen in a year.
Yeah, it takes time. But, again, if you're very diligent, 10 years, getting 1 or 2 properties a year, you can be really set up, pretty well. But again, that takes a lot of work. You have to really work your face off to make the first money, because getting started is the hardest part. Yeah. Although most people don't realize if you had $20,000 to $40,000, you can get started with a house.
Oh, yeah.
What is the number one piece of advice that you've either learned throughout your life or that you put into practice, something that's working for you, that would be super beneficial for a first-time home buyer or someone who's just trying to build wealth or get into the real estate market for the very first time?
Leverage. So if I'm paying $15,000, I want to try to charge my tenant maybe $2,000 or whatever, but it's leverage. Maybe buy a duplex. You're living in one side, have the other half rented out. Leverage. Like right now, maybe invest in a 3-month treasury. They're paying 4%. That will compensate for the 7 you're paying on the mortgage, or 6, whatever. So I always try to leverage. Like, what could I do? How could I invest short term, long term, to where I'm leveraging and not coming out of my pocket, so to speak.
So like, how do you leverage it? Like, how do you get a treasury bond at 4%? How do you know where to even find that?
That just happened.
Okay.
That's just recent on the market. You couldn't have done that 3 months ago.
Okay.
Or even certainly not last year. But there's always an opportunity, right? Whether it's T-bonds right now, maybe it was Airbnb last year. Maybe it was rent out a room. If it's just you in a 3-bedroom house, rent some rooms out. If you're close to downtown, when UT has a game, rent it out for a weekend. Find some corporate. There's all kind of ways to leverage.
So basically, leverage being you're utilizing what you own, your house, to make money to pay for that, and then of course it's appreciating over time, right? Things like that. So you're basically avoiding the cash flow. You're basically living somewhere and having someone else pay for your mortgage in order to live there. So essentially living for free, which is your goal, right? So just leverage what you have to live for free and lower your expenses so you can do more things that you want and not be putting so much pressure on yourself, for example.
Yeah, and some of that may take time, especially if you're trying to invest in But starting out, if I was coming in single, no kids, I'd buy a duplex all day, maybe even 4-plex all day.
Yeah,
rent it out.
Just rent out the rest and live in one
for a year.
Boom. Also called house hacking. So I'll do a podcast on that and a YouTube video as well on house hacking, how to get started. What my brother and I did to basically pay no mortgage over 2 years in our first house that we bought, and what we were doing going forward with different investments and things like that. So Jeremy, thank you so much for being here. I know everyone that's listening to this definitely learned a lot. I've learned a lot today. So we appreciate you a lot.
It's my first podcast.
Yes, you did great. You got a good podcast voice.
So maybe I'll get crushed on the YouTube.
Yes, yeah, maybe, right? Nonsense. Don't worry about it.
I'm coming for you, Joe.
That's right. You're coming for this job. So you can learn more about Jeremy and get connected with him on LinkedIn. That link will be in the description, going forward. All of our social media, handles and profiles will be in the description as well. If you're listening to the podcast, make sure you subscribe to the YouTube channel as well. Appreciate you guys. We're over 150 subscribers at this point, so that's really good news. Hopefully we'll get 200, 300, and I'll just keep updating you guys as we go. But, I guess want to say appreciate all of you guys for listening, and hopefully this is really informative and educational, and hope you enjoyed, and I hope that this will help you not be young, dumb, and broke, and instead be better off in your life in all those different ways. So appreciate you guys.